US jobs growth is much weaker than expectations, raising questions about whether the Fed could cut 50 basis points rather than 25 next week. Also, Japan's Prime Minister resigned last week, which could weaken the yen. That's coming up in our 5 Things in 5 Minutes on Monday, September the 8th. And then in our deep dive interview, ANZ's Group Chief Economist Richard Yetsenga looks at why long bond yields are rising.
It's not that the market's saying a government is about to default, but it does seem like investors are saying, if you want me to buy a bit more of this new issue, you just need to pay me a little bit more to induce me out of other assets.
But first, in 5 and 5 with ANZ, US jobs grew just 22,000 in August, which was barely a third of the consensus forecast. Revisions to previous months mean the 3-month moving average has fallen to around 29,000 since May. It had been well over 200,000 earlier in the year. ANZ economist in London, Bunzi Madhavani, says that sort of monthly growth is not enough to keep unemployment stable.
Looking closer, the data does raise concern about the vulnerability of the labour market. Excluding education and healthcare sectors, there has been no jobs growth in the private sector since May. At 4.3%, the unemployment rate did remain below its long-run average, but there are meaningful upside risks based on weak hiring momentum and a possible pickup in the participation rate. So overall, the data confirm that labour market is indeed weak.
As of 4 a.m. Sydney Melbourne time, the S&P 500 closed down 0.3% on Friday night, and the Nasdaq was flat. The yield on the 10-year US Treasuries was down 9 basis points to 4.086% on those weak jobs numbers. Gold closed up 1.3%, again, thanks to those lower interest rates, at $3,653 US an ounce. West Texas oil futures were down 2.5% at $61.87 US a barrel, and that was before OPEC surprised markets last night with another increase in its oil production of 137,000 barrels a day. The US dollar index was down 0.6% with those lower interest rates. The Aussie dollar up 0.5% at 65.57 US cents. And the Kiwi up 0.8% at 58.94 US cents. Number 2. So what do those weak jobs numbers mean for US interest rates? Here's Bunzi again.
Earlier, Chair Powell had already signaled that labour market weakness warrants a shift in stance. So we expect monetary policy easing to resume when the FOMC meets later this month. On our part, we maintain that a 25 basis point rate cut remains the baseline outcome, but there is now a possibility that some FOMC members or even financial market investors could start considering a 50 basis point rate cut move.
Number 3. Japan's nominal wages grew 4.1% in July from a year ago, up from an annual growth rate of 3.1% in June. That was partly due to summer bonuses, which rose 7.9%, while base pay rates for full-time workers rose 2.8% from a year ago. Here's ANZ Head of FX Research, Marjabeen Zaman.
I think what really stood out is that real wages have come into positive territory for Japan after being in mostly negative territory for most of the year, which I think is a positive driver and kind of adds a little bit of weight to the Bank of Japan continuing its normalization of interest rates. We do expect a rate hike on the BOJ in October, but of course a lot of that depends on what happens on the political front.
Number 4. Speaking of politics, Japan's Prime Minister Shigeru Ishiba resigned last night ahead of a confidence vote in Parliament this week. Marjabeen says a new PM may not be so keen on the Bank of Japan hiking interest rates again.
There is one candidate that comes up quite a fair bit, which is Sani Takeichi, who finished second to Ishiba in the LDP leadership race last year. She is one who favors stimulus and is likely to favor the Bank of Japan to take a little bit more of a cautious view on their rate hikes. And if that's the case, in that case, you would likely see the yen weaker rather than stronger for the near term.
Number 5. Philippines Consumer Price Index inflation rose to 1.5% in August from a year ago, from an annual rate of 0.9% in July. Core inflation also rose to 2.7% in August from 2.3% in July. Here's ANZ economist Arindam Chakraborty.
The increase in headline inflation was largely driven by a sharp rise in fish and vegetable prices, which were impacted by weather disturbances that disrupted supply chains. We also saw pump prices edge higher compared to the previous month, contributing to the uptick in non-food inflation. Despite this increase, inflation is expected to remain benign in the near term, supported by favorable base effects and easing global cost pressures. Given this outlook, we believe the BSP will have room to cut the policy rate by another 25 basis points in the fourth quarter.
Aaron Chakraborty there. Now, in our deep dive interview, ANZ Group Chief Economist Richard Yetsenga puts Friday's surprisingly weak US economic data into context for global interest rates and long-term interest rates in particular. I asked him first, though, about how the US jobs data changes the global outlook.
I think a lot of people will view the jobs numbers as validation for the idea that tariffs will sap growth because they push costs up, they push prices up. They're a tax in the system somewhere, and who absorbs them initially in some ways is a moot point. They must ultimately end up either in lower sales or higher prices, and it looks like you're getting a bit of a combination of those. So the market now very confident in the view that the Fed will cut by 25 basis points at its September meeting. The market will flirt about 50 as markets are inclined to, and I think that's honestly the right discussion for the market to be going through. The risk of the alternative to 50, of course, is zero. The risk of that seemed kind of zero, and we have this important inflation number out later this week. If inflation gives the market an excuse,
could it go 50?
I think it will continue to toy with this idea that maybe there's a chance the Fed goes 50. It doesn't seem all that likely, but if inflation were to really shock us on the low side, then it could encourage the Fed in trying to catch up.
And what about for the rest of the year? 3 or 4 cuts?
The market has been pricing more than our forecasts for a little while. Over the next 6 months, we have 3 cuts. The market has a bit more than 4 over that period. A lot hangs on this September meeting and the outcome of the CPI this week. I think if the CPI encourages the Fed to go 50 in September, of course, then our expectation of 3 cuts over 6 months looks quite light.
What do you think of this rise in long bond yields, particularly in the likes of the UK and France and India?
There's a kind of a steepening in yield curves, a rise in the term premium, if you like, which is the term the bond boffins use. And it's always a bit difficult to pin down exactly what's driving this. It's one unobservable variable being explained by other unobservable drivers. But it does seem like bond markets are saying there's a fiscal premium here to issue long duration bonds for governments, that it's not that the market's saying a government is about to default, but it does seem like investors are saying, if you want me to buy a bit more of this new issue, you just need to pay me a little bit more to induce me out of other assets. You can see it in the US, the UK, the long end of European bond curves in Japan. You can also potentially, if you like, see it in India. There seems to be some more short-term dynamics in India in that, but certainly over the course of this year so far, if we look at the yield curves across Asia, India's has steepened substantially more than any other economy in the region. It also seems like there's a bit of investor concern about just what the fiscal dynamics look like.
There's been a lot of noise over the last few weeks about the US Federal Reserve's independence, with criticism from the president of the governor. What should investors, people owning businesses, think of this broadly and watch out for?
What to watch out for is a tough one, because one of the things, of course, about the Trump administration is unconventional, unpredictable, and not particularly bounded by what has been common practice in the past. But it does certainly seem to me that the Fed, as I have understood it over the past couple of decades, is fading from view. There's a different relationship between the Fed and this administration, which is currently kind of at the boundaries of that being worked out, you might say. But it does imply, interest rates perhaps operating slightly differently, the Fed's balance sheet potentially being operated in a slightly different way, even potentially the way the Fed conducts supervision of the financial sector being operated in, and all of those areas potentially just a bit more aware of what the wishes of the current presidency are, and those wishes permeating into policy. Look, at least at the margin, I'm not sure that we can be really confident about how deeply those kind of influences will go, but they seem to be there, certainly more than has been the case for a couple of decades.
Richard Yetsenga there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, September the 8th. Catch you tomorrow with a look ahead at what's happening with US inflation. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.